Hello and welcome to Livewire Markets. My name is Chris Conway. For today's Fund in Focus, we're sitting down with Warryn Robertson, who is the Portfolio Manager for the Lazard Global Listed Infrastructure Fund. It is available both as a managed fund and an ETF, trading under the ticker GIFL. Warryn, thanks for sitting down with Livewire.
Pleasure to be here.
Warryn, can you please provide an introduction to global listed infrastructure and how you define your investable universe?
Infrastructure generally is essentially how we go about our daily lives in the developed economy. So it's the toll roads, it's the airports, it's the electricity and gas networks that make us be the humans that we are in any sense. Our job though is to not just consider the physical characteristics of infrastructure, but more importantly, what are the really attractive investment characteristics. So we look for those infrastructure assets that are monopolistic in nature, have inflation protected revenues or returns, typically will have high margins, high free cash flow generation, and operate in countries where there's a high degree of regulatory and political certainty. Because these are essential services that attract people on an everyday basis. So you need to be sure about the political and regulatory environment. And so for us, that's our investable universe, that select group of companies.
Warryn, can you just talk through the track record that you guys have in infrastructure?
From our defined universe of about 90 odd investment opportunities today, and if you look at the last almost 20 years that we've been managing money, what we've been able to produce is a return that has been roughly 10% per annum, which has been quite pleasing for us. It's had good downside protection, so you've typically seen equity betas of about 0.7, you've seen standard deviations of those returns less than general equities, and most importantly, when markets take flight and they retreat and it has downside protection capture of about 57-60%. So typically if markets fall 10%, we only fall 5.5 to 6. So that it's doing its job in terms of that ballast of a portfolio.
Warryn, you're launching the products now as an ETF. Is there any differences between the ETF and the existing strategy?
Pleasingly no, from my perspective as a portfolio manager. And for clients, it's essentially just a new avenue for them to access the exact same strategy that we've been running for 20 years. It'll be the same unit holder, so existing clients will be able to continue to do what they've done and access it via the unit holder structure, or they can now access via the ETF and buy and sell as they would any other share on the exchange. So we think it just provides a great benefit for existing shareholders and unit holders and potentially opens us up to new opportunities for new investors.
Warryn, you've talked a little bit about the Lazard process. What really makes your process unique? There's a lot of infrastructure opportunities out there, but what's key to Lazard's process?
I think what makes us unique is that strict definition of what we call preferred infrastructure. They're monopoly-like, they're inflation-backed revenues or return structures, they're high margins, manageable debt structures, and also with operating in countries with good regulatory and political structure. I think that strict adherence to that definition has served us incredibly well, because it means that we don't get distracted by opportunities that may look like infrastructure investments but don't have that long-term visibility on and sustainability of earnings and cash flows.
Let's talk about what's going on in the space right now. We'll take theory into practice. What trends are you seeing?
There's two major trends. The first is obviously the energy transition, and the second one is the definition of infrastructure and how that's changing in some people's minds. So the energy transition is going to have a pronounced effect on global markets and how they operate, not only in the infrastructure space, but just in our everyday lives. And we're all au fait with the concept of reducing the reliance on fossil fuels and accepting that renewables will be the new way of generating electricity into the future and energy into the future. So if you think about it in the construct of what we're trying to do when we manage money, we are not interested in really investing in new early stage green hydro potential projects that might one day make money if they can get the technology to work. That's not our bag. Our bag is saying, let's look at the existing infrastructure assets that are out there, the ones that can take advantage of this energy transition. So you're thinking of companies like National Grid of the United Kingdom, which has all the big poles and wires for electricity networks and the big transmission gas network. Turner, which is of Italy, doing the same thing in terms of electricity poles and wires. These are companies that are essentially taking renewable projects that might make money in the future and attaching them to their existing grid, and they'll get a guaranteed return on that. So the analogy I love to use is they're selling the picks and shovels to the gold miners. The gold miners might make money, but the guy who sells them the picks and shovels or the Levi Strauss jeans, they did make money. And so what we're doing is capturing that growth but also getting it in a very attractive risk-adjusted way. The definition of infrastructure is changing. That's the second big trend we're seeing. Along those lines, example of that is data centres. People are considering that as part of an infrastructure portfolio. We take a different view. We think that yes, they have the physical like characteristics of infrastructure, but they don't have those investment characteristics. They're not monopolistic. They are quite competitive. Others can go and build a new data centre tomorrow. The contract terms are quite short. They don't typically have CPI-linked revenues. They might have good margins today, but with that lack of monopolistic structure, new competitors coming in with the new data centre, which gives you more added benefits, the customer switching costs, although they're there, aren't insurmountable. And so we think that, in terms of the longevity, in terms of that forecast stability that we want, they just don't make the grade. So for us, we're sticking with what we know.
Warryn, you talked about a couple of companies there. What is a core holding that really crystallises the whole conversation we've had to this point?
Yeah, so I think probably the one I would pick on would be a company called Ferrovial. It was a Spanish construction company that started to develop infrastructure assets and has really now become one of the leading owners of toll roads around the world. Essentially, most of its value, in our way of assessing value, 3/4 or more, is in 5 roads. They are all in North America. One is in Toronto in Canada, the 407, and there are 4 managed lanes, 3 of which are in Texas, 1 of which is in Virginia. These roads have long-term concessions, 50 to 90 years. They have dynamic or flexible tolling, which means that unlike Transurban, which is linked and capped in terms of what tolls it can increase, these 5 toll roads can charge whatever they like to whoever uses the road, as long as essentially for one road they don't double tolls in a 6-month period. So it's incredibly liberal tolling regimes. And what we've seen is these assets, because they're operating in highly congested corridors, traffic continues to grow in spite of quite considerable toll increases. So from an investment perspective, the 4 US managed lanes essentially have grown EBITDA collectively from $200 million 4 years ago to $800 million today. It's astounding just how fast they're growing, and the benefits they provide to consumers are considerable, because essentially you're travelling 50 miles an hour and the person who's not paying the tolls doing 10 miles an hour in peak hour. And so that's a genuine benefit that people are willing to pay for.
Just one follow-up question there, if I may. The 50 to 90 years, that's much longer than the toll roads here in Australia, isn't it? Is it normally 30 years?
Typically you'd see 30 years. A couple of the concessions, like the Old Hills Motorway, Lane Cove Tunnel, they were 48 to 50 years, Eastern Distributor. But yes, they are very unique assets in many ways, not just the length of the concession, but the dynamic tolling nature.
Warryn, how is investing in listed infrastructure different than investing in global or domestic equities?
I mean, clearly you're focusing on a set of businesses that have unique investment characteristics, but at its heart, investing is the same regardless of which particular companies or assets you're looking at. In essence, my job every day is to forecast earnings and to put a multiple on it to come up with a valuation, or to forecast cash flows and put a discount rate on it to come up with a valuation. The beauty of infrastructure is that those earnings and cash flows are actually easier to predict than they are for virtually any other companies that are out there. So what that means in that solving that investment problem, I've got half of the problem, which is a much easier one to solve. And in fact, the multiple and discount rate's pretty easy as well. So the valuations are much more robust. And what is such an attractive thing for me as an investor, outside of the fact of being an infrastructure investor, is that these assets, even though they are easier to predict, easier to forecast, better to get a handle on what valuations are, can trade quite considerably away from that valuation, because the market's focused on short-term noise, not long-term value, and that's what creates that fantastic opportunity for us to generate genuine excess returns over what should be a very simple, boring asset class. You can generate great returns. It's fantastic.
Warryn, how do you think investors should take that and then think about an allocation to infrastructure in their portfolios?
I mean, I'm biased. I'd say everyone should have infrastructure in their portfolio. But if you think about where it sits, essentially if you think about allocating assets along a risk spectrum, you've got cash and bonds down the lower end of your risk spectrum. You've got equities and new early stage venture capital at the upper ends of risk. Infrastructure sits in the middle, kind of where property sits, but with some better characteristics, I would argue, than property, namely the monopolistic nature of the ones that we focus on, those inflation-linked characteristics. I think inflation is going to be a much more important part of the investment conversation for investors, not just today, but going into the future. And so understanding the nuances of how certain assets will behave in a more inflation-driven environment is critical. So I think if you think about infrastructure sitting on a risk spectrum between bonds and equities, and then that's where the asset class sits. And with, as I said, the ability to add value to that static return through astute stock picking, I think it really does stack up as an attractive risk return proposition for investors.
So Warryn, now that we understand where you see infrastructure on the risk spectrum, what is the return objective that you're focused on?
Look, we try and seek a return for investors of inflation as measured by the ABS Bureau of Inflation, plus 5% over rolling 5-year periods. And we think that's a combination of both a solid income return from dividends and distributions as well as growth. And we think that positions it where people should think about long run returns for bonds, which we would characterise as, in a nominal sense, 4, 5, 6%, and equities around 10%. So infrastructure sits in that space in the middle, and that's where the returns should be, and if we do our job, hopefully a little bit better.
Fantastic. Last one, for anyone who wants to know more, where can they get some more information?
With the new ETF now, you're able to access it via the Lazard website. You can talk to your existing financial advisor or any stockbroker.
Warryn, thanks so much for sitting down with Livewire.
Chris, always a pleasure. Thank you.